As of August 6, 2026, the U.S. equity market is currently closed, and NVIDIA stock closed its most recent regular session at $218.99, reflecting a slight fractional dip of 0.10% on an intraday trading volume of roughly 113.9 million shares, following an opening price of $221.53 and a session high of $223.63. While the surface figures suggest a quiet, range-bound consolidation phase, the order flow narrative underneath tells a far more dramatic story. Most retail market participants watching NVIDIA stock look at these minor ticks and assume the hypergrowth narrative is simply cooling down into a predictable holding pattern. The widespread assumption across mainstream financial media is that hyperscalers are running out of immediate capital expenditure budget or that data center buildouts are hitting physical utility constraints. Reality, however, points to an entirely different structural shift. What looks like price stagnation on a daily chart is actually an aggressive institutional accumulation zone where large funds are absorbing profit-taking from early buyers who are eager to lock in gains before the upcoming quarterly earnings release. The market expectation rests on the idea that hardware demand must eventually hit a cyclical ceiling, but the operational reality inside cloud data centers proves that compute supply remains severely constrained relative to enterprise AI deployment needs. When you track NVIDIA stock across major online investment platforms, you see retail sentiment wavering between extreme fear of a valuation top and relentless fear of missing out on the next leg up. On self-investing channels and active online trading apps like Robinhood Stock Trading and SoFi Invest, retail traders often treat every single pullback as a sign of institutional exit. Yet if you examine deep order book dynamics through institutional platforms like Interactive Brokers Trading, you spot massive block trades executed precisely during these midday pullbacks. Institutional portfolio managers utilizing Schwab Intelligent Portfolios or structured allocation engines within Fidelity Wealth Management are not abandoning semiconductor exposure. They are rebalancing risk profiles while systematically building core positions. The disconnect between public retail narrative and back-end market mechanics creates a powerful dynamic. While retail investors speculate on whether the latest chip architecture iteration will experience minor delivery friction, hyperscale cloud operators are signing long-term power purchase agreements and committing tens of billions in future capital expenditures just to reserve server racks. To understand why NVIDIA stock trades at these levels, we have to pull back the curtain on recent daily price movements and market liquidity. Over the last several trading sessions, volume patterns have shown consistent accumulation during late afternoon sessions. Every time the share price dips toward its lower intraday boundaries, institutional buying programs activate, mopping up floating supply. This price action isn't occurring in a vacuum. Sector momentum across technology equities has experienced sharp rotations driven by shifting treasury yields and broad macroeconomic debate around federal interest rate paths. Yet despite broader market turbulence, semiconductor stocks continue to act as the core collateral base for equity indexes. When traders use individual brokerage setups or manage positions via SoFi Trading Platform, SoFi Active Investing, or Robinhood Investments, they frequently place stop-loss orders around key technical support levels only to get wicked out as institutional market makers sweep liquidity pools before pushing prices back into neutral territory. Comment below how many shares of NVIDIA stock you currently hold in your portfolio, or tell me if you are waiting for a larger pullback before buying more. Beyond the daily trading swings and ticker volatility lies the actual economic machine driving these financial metrics. NVIDIA designs high-performance graphics processing units, enterprise networking interface hardware, and complex software stack ecosystems that serve as the foundational compute engine for modern global intelligence systems. Its business model relies on a fabless manufacturing architecture, outsourcing physical semiconductor manufacturing to leading global foundries while keeping high-margin intellectual property, software architecture, and system integration in-house. While casual onlookers view the company purely as a chip maker, its true competitive moat is its integrated proprietary compute architecture and parallel computing software environment. By coupling hardware accelerators with specialized developer software tools, the company established an ecosystem where developers build applications specifically tuned to its architecture. This software lock-in makes switching costs prohibitively high for hyperscalers, turning simple chip sales into long-term infrastructure dependence. Looking back at past financial performance provides essential context for today's market pricing. In previous market cycles, semiconductor companies were plagued by violent, unpredictable inventory bullwhips. A surge in consumer electronics or personal computer demand would trigger massive overproduction, followed by massive inventory write-downs and severe margin compression. Investors who remember those historical downturns continuously project that old semiconductor cyclicality onto current operations. But current enterprise infrastructure procurement operates on entirely different unit economics. Data center compute architecture has shifted permanently from general-purpose central processing units to accelerated compute systems. Historical reports show that during prior tech transitions, companies struggled with single-digit software margins and commoditized hardware components. Today, enterprise accelerated hardware packages carry software-like gross margins, completely upending traditional semiconductor balance sheet evaluations and leaving legacy analyst models trailing behind real-world corporate profitability. Understanding this contrast between past market cycles and modern enterprise demand is critical when navigating online investing decisions today. Whether an investor utilizes Fidelity brokerage accounts for tax-advantaged retirement planning, explores Robinhood cash management and Robinhood fractional shares for quick exposure, or uses SoFi Robo-Advisor for automated asset allocation, understanding long-term enterprise capital flows is far more valuable than reacting to daily noise. When evaluating self-investing options across top investing sites, individual market participants often overemphasize quarterly supply chain rumors while ignoring broad structural trends. For instance, when headline risk surfaces regarding potential export restrictions, global geopolitical friction, or localized supply chain bottlenecks, retail trading apps often see panic selling. Meanwhile, institutional desks operating through Interactive Brokers platform or managing assets via intelligent portfolio systems leverage that short-term volatility to build structured options hedges and acquire underlying equities at favorable valuations. Looking ahead, the market setup for NVIDIA stock rests squarely on the tension between sky-high revenue expectations and long-term infrastructure return on investment. The prevailing market anxiety questions whether non-tech enterprises buying AI compute will generate enough revenue to justify their capital expenditures over the next 3 to 5 years. If enterprise adopters fail to monetize these digital workloads, critics argue, hyperscalers will eventually scale back their hardware purchases, leading to a sharp contraction in chip demand. This expectation of an impending capital expenditure cliff is the primary reason why price-to-earnings multiples on the stock have periodically compressed even as revenues hit record highs. The counter-argument, backed by real-world data center lease commitments, is that software automation, autonomous system development, national infrastructure compute projects, and complex frontier models require exponentially more compute capacity for model training and real-time inference than current power grids can even support. Furthermore, future operational catalysts extend far beyond traditional cloud data centers. The deployment of physical automated systems, advanced robotics, autonomous transit infrastructure, and localized enterprise edge computing nodes represents an expanding operational surface area for high-performance hardware systems. As industrial manufacturing plants, healthcare networks, and logistical infrastructure integrate localized intelligence engines, compute demand expands out of centralized data servers directly into local operations. For individual investors managing portfolios through Robinhood app, SoFi stocks, SoFi ETFs, or exploring investment help through Robinhood crypto and alternative assets, assessing these long-term secular catalysts requires looking past daily market movements. Managing equity positions requires analyzing whether new product architectures can maintain profit margins while scaling throughput under increasing power and thermal constraints. When you evaluate potential downside risks, operational challenges cannot be ignored. Geopolitical tensions surrounding cross-border supply chains, potential manufacturing disruptions, and regulatory scrutiny regarding market concentration present real headwinds. Additionally, major technology customers are actively developing custom silicon in-house to reduce their reliance on third-party suppliers and lower long-term infrastructure costs. If hyperscale software giants successfully transition a substantial portion of their internal